Right. We're still on the topic of loan hedging. Today, we're going to look at the balance sheet impact in the case you are borrowing in a foreign currency. So imagine you're taking out a foreign currency loan. The balance sheet can actually be quite volatile. And the main reason for it is that you will record your liability at the value of the exchange rate on your reporting date. So you'll have one rate to start with, you'll know what you get, and then during the life of the loan, exchange rates are going to fluctuate, and that can create volatility on your balance sheet. Quick note, Bound does not give accounting advice, so always check with your auditor or accountants, and it's specific to your accounting standards as well. So imagine you are a GBP functional company, and you sit here in the UK and you have just borrowed a loan in US dollars. Let's say it's $10 million. It's a foreign currency for you. The tenor is 2 years. We're going to disregard interest rates for simplicity reasons for today. And then we're going to look at 3 scenarios. One is that at inception, the exchange rate is $1 4.8 sterling. It then changes after a year to 0.7 sterling. And after 2 years, it will be 0.9 sterling. So first, let's look at the balance sheet impact without any hedging. So you have borrowed $10 million. You exchange that at the agreed rate into 8 million sterling. And that is an asset on your balance sheet in the cash section. So cash there, pretty simple. Liabilities, you have a loan. The loan equals 8 million pounds as well. And that is because at inception, the exchange rate between the cash you get and the loan you've taken out in dollars is the same. So now, what happens in year one when the exchange rate changes to 0.7 sterling? In case you haven't spent it, you'll still have an asset of 8 million pounds in cash. On the liability side, your $10 million are going to be worth only 7 million pounds right now. And you'll have an entry in your equity section in order to make your balance sheet balance, which is an FX gain of 1 million pounds, so that your liabilities in total are still 8 million and your cash is 8 million. However, part of that is made up by the FX gain that you have, and it's an unrealized gain in this case. So what happens in the next year? The FX rate has moved against you in our scenario here, so cash still 8 million. In pounds, the loan is now worth 9 million pounds that you have to pay back. So you will have an unrealized, but then also a realized loss when you pay back the $10 million, because you now have to come up with 9 million in pounds worth for your 10 million of dollars. So quite quickly, let's get into the hedging bit. What can you do in order to mitigate that volatility? You can enter into a 2-year FX forward to exactly match your liabilities, and at inception, nothing has changed, so you still have an asset and a liability of 8 million pounds. With the forward in year one, you would have still assets of 8 million in cash, and then liabilities will change because remember, you made an FX gain, so your liabilities are worth only 7 million in pounds. However, your forward will have moved against you, so that will be another 1 million in liabilities that you have with the forward. And always try to get the forward as close to the underlying asset or liability that you're hedging, so that both set each other off perfectly. So same will happen in the next year, where the foreign exchange rate has moved against you. You still have the 8 million in cash in case you still have it. But then on the liability side, you'll still have an 8 million combined liability because you have 9 million in loans to pay back your 10 million in dollars. And you have a 1 million negative liability of a forward, which you can set off against the loan of 9 million pounds. So 9 million minus 1 million essentially. So you pay back 8 million pounds worth for the 10 million of dollars. So no change in equity, everything nice and clean. And that's really it. Thanks for watching.